Hi there. My name is Austin Lawrence. I'm with Pacific Wholesale Mortgage, and I would like to share with you today a little bit of information on the appraisal dilemma. And this is just going to come to you from the perspective of an actual loan officer who's just trying to help out and kind of give you a little heads up about some strategies that will help you developing what we call appraisal insurance. So again, my name is Austin Lawrence, and I am the main loan officer at Pacific Wholesale Mortgage. And what I am going to do is just basically share kind of a PowerPoint of some strategies to help out dealing with a little bit of the appraisal issue or the appraisal dilemma that we're dealing with in today's market. So what happens when an appraisal comes in low or short of the expected value? So you have a home, you're thinking the home's going to come in at 525,000 and the home comes in at 500,000. So what do? You will not you will not have an official appraisal on a property when you go into contract. So you should have completed what's called a market analysis on the subject property before making an offer, because you're saying, well, I haven't had an appraisal yet, so how do I know what that value is going to be? You want to really try to do as much research as you can to come up with the best guess on where you think you're going to be at. So keep in mind, most appraisals are reflecting the value of what the sold homes have been receiving over the past 3 months. Also, those homes, or what we call comps, must have comparables and be within a reasonable distance from the subject property. So this is an example of a value estimator, or what I would say you would do in a particular area or home. So let's say this home that we're looking at, we're thinking it should be coming in at 525 because that's what we want to offer. And we're finding that the house, which is on the left here, you see it says house canary value. What you're basically seeing is that this house is guessed to be valued at about 485,000. So in this scenario, I would immediately shift gears and try to focus on ways to really compensate for what happens if it comes in at this actual value versus you're going to go ahead and make an offer at 525,000. Well, if that appraisal comes in at 485, how are you going to cover that other $40,000? That's the real question. So that's kind of what we're talking about when it's the appraisal dilemma is what we're really addressing. So I want to just kind of go back a little bit, and I want to talk about values and rates just to give a context of where I'm going to go with this. So if you look at generally where values were about 2-3 years ago, and I put 2017 in here, but that's really reflecting 2018 kind of medium. What you're seeing is the rate is about 4.5%. Now the house values or home values at the time were probably at about 510. And we're going to compare that to the same exact house looking at it from this year. So in that sense, we're still looking at a little bit of a different scenario, because at that time you would have had to put down 5%. So fast forward to today, same house. Rates are better than they were in 2018 and as well in 2017. They had some lows, but for the most part. So we're looking at a rate of about 2.875, or just generally speaking, 2.88. So here you're seeing that you're getting about 1.5 or actually 1.7% better in rate. Now, the problem is the values have went way up. So you're looking at a house that's at about 610,000. But if you really kind of looked at it and just compared apples to apples, what you'd see is you actually have a lower payment, even though this house is increased in value over 100,000. The reason being, instead of the 5% down, you're only putting 3% down. So we are looking at a situation where in today's market, your purchase power is greater. And I would consider that when talking about values, the fact that values are going up at a rate of about 15% in the Northern California communities, average is about 7%, and you're getting a much lower rate. So you're getting more bang for your buck, so to speak, when it comes to your actual payment. All right, so moving on, I just wanted to give you a little heads up with that. So how do you mitigate an unexpected appraised value? You must and should have discussed this issue before it became an issue. So here are some possible solutions. So just knowing that you guys have had this conversation, I'm kind of just going to give you a general way to look at, here are some solutions for you. Number one, absorb the loss in the value within the rate. Whatever rate you get, usually you get a rebate on that rate. And that rebate will increase as your rate increases. So if you get 3%, you may get 2.5 back. If you get 3 and an 8, you may get 3% back. Well, that extra money between the 2.5 and the 3, that can be used towards your actual closing cost. So most rates have a cost or a credit. And what you're going to find is if you move up the rate, then what you're going to get is a little bit more of a return on that particular rate, meaning you can help cover some of your closing costs, anywhere from $500 to, I don't know, $8,000. Second option, change the down payment amount. An example is you adjust from a 20% to a 5%, or God forbid you go from a 20%, it comes in way low, this case $40,000 below what you expected, then I would maybe switch to looking at a 3% loan. And again, you should have looked at these scenarios in advance to know if they qualify for it. But this is a good way to kind of lower the actual commitment that you're making with cash, or to transfer that cash to something that's a little bit more productive for you, i.e. covering the discrepancy in the appraised value. This is the final one that I would say, and there's always room for this because people are being paid on these transactions and there is money in the back end. I would negotiate with your listing agent. You can alter some of the concessions. They can raise the value anyway to give you a credit back, just to help out. So there are so many different scenarios you can go in. Hopefully you, your loan officer, your buying agent, and the listing agent can all get on the same page and come up with some, solutions that actually help you out. Okay, now here's one of the scenarios that I came up with for my clients that I've been presenting if I'm in fear of that. And this is presenting the $525,000 actual purchase price. And then we're going to look at the scenario from what happens if that doesn't come in and we are looking at less of an appraised value, meaning we have to cover more cost. So here you're going to see 4 different ones. We start off with the ideal. We offered 525 and it came in at that. We're in a 3% down program. So in this scenario, you're going to be looking at basically a closing cost of about $28,000, which does matter. Now your payment's at about $2,200, which you kind of want to pay attention to that because that's what we're really trying to stay or to keep is your payment right within that same wheelhouse that we talked about before, that it's comfortable for you. So that's the goal of this, in essence, is to not only compensate for the lack of appraised value, but also give you that equivalent payment with not that much extra closing cost. Here's an example. So on the 520 value, meaning it came in $5,000 less. So how do we cover that $5,000? Well, if you look at my scenario here, I do have that your closing costs are $29,000. So what we did is we went up 1/8 on the rate, and we took more of a credit. And if you look down below, you'll see I gave a credit of $38.61. That's how much extra we got for going up 1/8 on the rate. Now, why is that significant? Because then we can use that money to offset the $5,000. And what you'll see is basically, yes, you are coming in with a little bit more closing cost, but not much. And payment only goes up $17. So that scenario is well within the wheelhouse to help solve this problem. Now, let's go a little bit farther. Let's say it comes in at 510. Now we're looking at $15,000 short. So we are dealing with quite an issue here and something that we really want to look at. How do we fix this problem? So what I did was I went up on the rate again. We went up another 1/8 and I got more money back. I actually got $6,800 back on this particular rate. So again, closing costs are increasing because we're trying to make up for that. So we're looking at $36,000, which from the original is $9,000 more. So we're really offsetting that $6,000 because remember, we are $15,000 short of what we thought originally with the credit. And then finally, I draw the scenario, worst case scenario. Let's say it comes in at 500. This is worst case for this particular pamphlet. 500,000, we wanted 525, we're $25,000 short. What do? Again, I went up on the rate a little bit to 3.5. We're looking at another $186 in payment, but you are getting $8,500 back in credit. So yes, we are going to have more of a closing cost, but it's not as bad as it could be. And this is a good way to talk about scenarios to make sure that you've actually looked at what we call appraisal insurance, meaning ways to mitigate the appraisal coming in low. All right, so let me review really quick because I know I'm covering a lot of information. Adjustments for appraisal issues. These are really what we're trying to do. So what's the solution if the appraisal comes in low? You are probably going to be in a situation in today's market where you have removed that appraisal contingency. So that's why this becomes really important, because the appraisal coming in high or low or not where you expected is not going to be a condition that's going to allow you to pull out of this without your client losing their earnest money deposit and all the other money they put into it, appraisal, home inspection, etc. Another solution, absorb the cost into the rate. And that's what I was trying to show you with regards to that actual Excel handout, is if it comes in at 525 versus 500, some ways to actually get rate to help compensate and help out with those closing costs. Another one is to adjust the down payment to compensate for a lower amount. This was the scenario we looked at where we're talking about you're putting down 20%, appraisal comes in way lower, and we take that money and instead of putting it down on the house, we go for a different type of a loan, maybe a 3% down loan rather than a 20%. And then we go ahead and cover those additional costs with that money. That's an easy solution if you have it. It's just a little bit difficult for most clients to take because they will be increasing their monthly payment because of mortgage insurance. So something you can ask me about if you wanted more questions, but that's the consideration there. And then finally, and I always say this is your absolute best choice. Negotiate, negotiate, negotiate with the other agents to close the purchase. You, the agent, the clients, all want this to close. So if you guys can stay focused on that, you will find solutions that will benefit and not prevent this from dying or losing its momentum in the process. So again, you want to be communicating and negotiating, and this goes into the contingencies and other ways to compensate for a lack of a appraised value that you want. Okay, finally, wanted to give you some important information. This is on me. Again, my name is Austin Lawrence. I am known as the Mountain Biking MLO because I am an avid mountain biker. And I also wanted to just throw this out there. If you have questions or you think that you are considering buying a home or refinancing and you just want to talk to somebody, please give me a call. There's no obligation. I'm not going to obligate you or make you fill out an actual application to have a discussion about your situation and some possible solutions. So again, thank you very much. I really appreciate you taking the time to listen to this. I hope it had some value, and I would love for you to please subscribe to my channel. I try to put out these videos at least once every 2 weeks with what's going on in the industry. And I also do market updates, and I throw in some quotes because I love reading myself and I like sharing, just some inspiring text. Otherwise, thank you again. Again, my name is Austin Lawrence. I'm with Pacific Wholesale Mortgage, and I look forward to helping you to get the house that you want. Thank you.